The previous class, we almost completed the area currency options, in which a small notes is pending for the risk neutralization model for valuing the currency options. Stop talking, please. Stop talking. Stop talking, please. சவுண்டு காலம்பரா இல்லையா? ஸ்டாப் பண்ண சார் 9 வரைக்கும். So we have got the notes to be completed in that currency option. Then we'll be starting with the futures chapter today. So we saw that when there is a foreign currency receivable or payable in future date, it is exposed to currency risk. The risk should be hedged. So one of the hedging is forward, another is money market. Like that, options also can be used as a hedging strategy. A person who is having a payable in foreign currency will buy the foreign currency tomorrow. So he will like to go for a call option in the currency. Person who is going to have a receivable on the future date will be selling the foreign currency tomorrow. Hence will go for a put option. So the advantage of option over forward is that in forward we lock ourselves to a particular interest rate, whereas in option it is not so. We can even lapse the option when the FSP is lower. This is what has been discussed. But the disadvantage of option is option involves a option premium to be paid. Such premium need not be paid for a forward contract. In that process, we did two problems: forward versus options. One is forward versus call option, another is forward versus put option. There we saw how to calculate the indifference point between the forward and then options. And we also discussed the break-even FSP when we have a time value of money. Then we discussed two problems: forward versus option versus money market hedge. We did one problem. I gave one problem put option as homework. Then we saw that cap and then floor as well as collar problem. Finally, when you can call a strategy as a hedging strategy, when you can call as a speculative strategy has been discussed. And for a UK based company, we also understood that if other countries they go for a call option for a payable, UK based company goes for a put option for a foreign exposure payable, and call option for a receivable exposure. We saw the reason that in Great Britain they don't create the option on the foreign currency as an underlying asset, they create the option on the pound sterling as an underlying asset. About that more detail, we'll do a problem in the futures. Next, we also discuss about risk neutralization method of valuing the option, where we saw in one problem that there is a currency option. $1 is equal to, I think today we had a spot price of 50 M. $1 is equal to 50. It may reach a FSP of 70 or FSP of 40. Last time we did now. And the strike price is 60. They ask you to value that particular dollar call option. So as usual, we went for a risk neutralization model where we equated the expected FSP to the spot price compounded to future. Normally we have spot price taken to the future using a compounding of rupees. But here we use the interest rate parity, because not only the rupee gets compounded, even the underlying asset also gets what? Compounded. So here the dollar became say e power 1.05 dollar approximately, and the rupee became 1.10, and then we calculated the probability. This is what happens in a currency option. Then we had a formula also. The formula for calculating probability is P is equal to e power t RH minus R of C minus D divided by U minus D is what has been discussed. Everybody, are you following or not? No. For that we discussed the logic on that day. If you ask me to repeat that once again, so now I'll repeat when I just dictate the notes in this regard. Can I proceed further? Write down notes. Write down notes. Notes. Point number 1. Point number 1. Point number 1. The first step in risk neutralization model is to calculate what? Risk neutral probability. The first step in risk neutralization model is to calculate risk neutral probability. Understand and write. Full stop, continue. This is done by equating what we equate here? Expected FSP with. This is done by equating expected FSP with the spot price compounded to future. This is done by equating expected FSP with the spot price compounded to future. At what rate? Risk-free rate. This is done by equating expected FSP with the spot price compounded to future at risk-free rate. Are you with me or not? No. Next. Point number 2. Before I dictate the point number 2, tell me the logic. What the logic of compounding a spot price to future at risk-free rate? So that through the price appreciation, the investor can earn what return? Risk-free return. That is, today I buy at 100, I want it to become what? 105, so that I can earn a risk-free 5% return. So that is what is the objective. Yes or no? Write down. Next, point number 2. The objective is to find out that probability which results in the price growth that gives the investor a risk-free return. That gives the investor the risk-free return. Everybody, are you following or not? So, for example, $1 50 rupees. Everybody listen. For $1 how much rupees? 50 rupees. Indian wants how much return? 10%. Forget continuous compounding. Only when the $1 becomes 55 rupees. How much rupees? 55 rupees. He'll be able to earn what? That particular risk-free return. For that, we should be able to set up the probability. Everybody understanding it or not? Now, please, all of you, have you all settled down now? Now, I am just repeating this for you. We already completed this in the previous class. Are you all following or not? Now, write down. For example, same point you continue. For example, in this problem, a dollar is rupees 50 today. In this problem, a dollar is rupees 50 today, and risk-free return required and the risk-free return required is 10%, and risk-free return required is 10%. Therefore, the expected FSP, to have this risk-free return should be, therefore, the expected FSP to have this risk-free return should be, how much? 55. Therefore, the expected FSP to have this risk-free return should be 55. To have this risk-free return should be 55. Everybody respond, are you following or not? Because today how much I invested? $1 is equal to 50. Suppose I want to earn a 10% return from this dollar investment. After 1 year, the dollar should become how much base? 55. So that I'll be earning what? 10% from the price rise. Are you following or not? Now, point number 2 or 3? 3. However, we calculated the required expected FSP. Expected FSP to be. How much? 47.56. The required expected FSP to be rupees 47.56. Are you following not? In bracket, right? Using what theory? IRPT theory. Using IRPT theory. Bracket close. Using IRPT theory. Why? Why? Did you all understand the question or not? See, I should have equated the expected FSP of 70 plus 40 minus 40p to be how much? 55. Then only I can get a 10% return or not. I equated only to what? 47.756 using IRPT theory. Why? Are you all following the notes or not? Now, write the answer. This is because the underlying asset dollar itself gives us how much return? 15% return. The underlying asset dollar itself gives us 15% return. Underlying asset dollar itself gives us 15% return. Hence, to earn our required 10%, the further return we require is, to earn our required 10%, the further return required is plus or minus minus 5%. To earn our 10% required return, the further return required is how much? Minus 5%. Hence, the expected FSP less than. The expected FSP less than what? Less than the spot price. The expected FSP less than the spot price. The expected FSP less than the spot price. Everybody, are you following or not? Now, did you understand the logic or not? Next. Last point. Point number 3 or 4? 4. Point number 4. To conclude, the risk neutral probability formula is, the risk neutral probability formula is P is equal to, please tell me the normal formula would be P is equal to what? E power TR of minus D divided by U minus D. e power t r of minus t divided by u minus d. Continue. However, if the underlying asset generates income, expressed as annualized percentage, then that income generated should be reduced from what? Risk-free rate. Then such income generated should be reduced from risk-free rate. Such income generated should be reduced from risk-free rate. The formula becomes P is equal to e power t r of minus e power t r of minus ri. I call ri means what? The return generated by the investment, that is underlying asset. E power t r of minus ri. This ri may be a foreign currency interest. The RI may be an annualized dividend on a stock, anything. It may be an annualized rent. Everybody follow what I am saying? And RI means what? The return generated by an investment, underlying asset. Everybody yes or no? So e power t RF minus RI minus what? D divided by U minus D. Minus D divided by U minus D. Minus D divided by U minus D. Everybody yes or no? Now, one more point, last point. Point number 4 of 5. If the income generated by underlying asset is given as amount, if the income generated by underlying asset is given as amount, is given as amount. Now, just a minute. Tell me if you are all awake. What I am trying to tell now. Given as what? Amount. Tell me some examples. Rent received on a vacant land is given as percentage amount. Dividend during the option period. Percentage amount. If they give it as amount, what you will do? Adjust against interest rate as spot price. We calculate as what? Revise spot price and then do the calculation. Everybody following? நீ எல்லாருக்கும் புரிஞ்சுதா? My yes or no now is given as amount. Then reduce such income from the spot price. Which we call as what? Revised spot price. Reduce such income from the spot price, which we call as the revised spot price. And proceed to do option valuation. Reduce the income from the spot price, which we call as revised spot price, and proceed to do the option valuation. Examples, we already seen one example, that is what? Rent in the vacant land problem. Example, rent in the vacant land problem, dividend received during option period, etc. Rent of the vacant land, dividend received during option period, etc. Now, this concept more will use in the next chapter. We are going to start called as what? Futures. Thereby we will be discussing something called as the forward futures price, the convenience yield. All this will be coming only through this particular concept. To this section, are you following the concept or not? Now, I just conclude. The notes is enough or completed. Let us conclude and then proceed to the next chapter. Now, everybody tell me, I have an option on an underlying asset. There are two situations. Underlying asset may not generate income Underlying asset should generate what? Or will generate income. Okay. Where underlying asset does not give any income during the option period, how can I earn from the underlying asset? Only through its price rise. Yes or no? That is, if the underlying asset does not give you any income during the option period, the only way in which I can earn my risk-free return, which I expect, can be only through what? The increase in price. Are you following what I am saying? If the underlying asset generates income, then the entire required income may not be through what? Increase in price, because already an income generated by underlying asset is going to reduce that. Everybody, yes or no? In such a case, they can give the underlying asset income in two ways. What are two ways? Yeah, expressed as an annualized percentage. Second, expressed as what? Amount. Okay. Annualized percentage only this problem where I have a foreign currency interest rate. Yes or no? Amount means what? Rent on a land, or what? It can be a dividend on a share, etc. In such a case, if they give us an annualized percentage, reduce the percentage from what? Risk-free rate. If they give it as what? The amount, say find out the spot price minus present value of that income, we call as what? Revised spot price, and then proceed to do the calculation. Everybody, I have the clarity or not? Now, with this we complete this particular area called as currency options. Now, can I move to the next area, futures or not? Now, give that is options, I can say is almost 95% complete. Some balance is left because when I do swaps, I call something called as swap options. And when I have also one more real option problem also to be done.